Good afternoon and welcome to True Potential's Weekend Markets. I'm Matt Henderson. I'm one of the portfolio managers here at True Potential. I'm joined by my colleague Joe Forward from the investment team. He is one of our investment analysts and we're going to talk you through what's been happening this week. So Joe, been quite a lot of market volatility this week. We can see that in both equity markets and also fixed income markets. If we look at measures of volatility, so things like the VIX, in the move, where they're looking at vol of equities and bonds, we can see volatility has been above the 1 year average. And really vols come from two major economic regions, the US and Europe. So if we start with the US, Joe, what's been going on?
Yeah, so if we rewind maybe to around a month ago, you probably remember Trump announced some tariffs on Canada and Mexico. The tariffs were then delayed by a month and they were put into place this week. So 25% on Canada, 25% on Mexico, and then there was also a 10% addition to the China tariff in place.
And that took it to 20% in total.
Yeah, exactly. And straight away, you've had these countries retaliate with tariffs themselves. And what does this do? It just fuels, worries about a trade war. But if we're kind of looking just into the US, it fuels the kind of concerns around inflation as well, because the businesses essentially face those costs. They pass those costs to the consumer, and then you get inflation. Elsewhere in kind of Trump's policy, you've got some of his immigration policy, so tight immigration. What this means is you're essentially getting a bit of a tighter labour supply, so reducing that labour supply, which means that there's actually more bargaining power for the workers and potential for wage rises. Now, wage rises, obviously, they're healthy, but you want to keep them under control, particularly when you're in a bit of an inflationary sort of era. You want to keep it pretty tight.
And I guess what markets are concerned about is that we return to a 2022 type of environment where inflation spikes out, the Fed have to follow it up by increasing interest rates. And an interesting point you made there about the tariffs is similar to what we saw in 2020. Firms will actually look to pass those price hikes on to the consumer, and then that's where we see price inflation come from. So rather than look to reduce margins, they'll look to pass that on. So I guess, you are right. We're seeing tariffs come through and that's creating volatility within asset markets. So if we look at the US equity market, to date, it's now actually negative. It's down about 2%. So it's actually wiped out some of the post-Trump election euphoria that we saw in the US. But what we do think is quite an important nuance that you, myself, the rest of the team talk about at the desk is actually, if we look at those different sectors within the US, we've actually seen the tech sector underperform a bit. So if we change the weighting methodology of the US index, we look at it on an equally weighted basis, so each stock has the same weight, that index is actually flat. So we can see what's happened within US tech that's dragged it down. So that's due to, as you said, volatility within tariffs. We spoke previously about Chinese AI, the threat that presents to the US, and also just the higher valuations that the US equity market trades on. I guess your important point that you pulled out, Joe, was just the market worrying a little bit about inflation. Do we return to a 2022 type of environment? And as a consequence, we saw US bond yields rise this week. So investors would typically expect that to be a diversifier, equities down, fixed income will kick in. But when markets are thinking about inflation, that's really why bonds haven't acted as the diversifier that you and I might have expected. But really it's to do with inflation. I guess what we would add to that as well is that US Treasury yields are down quite a lot already this year. So maybe that's a bit of an impact in there as well.
Yeah, and if you think about just looping back to the tariffs as well, it is a fast-moving environment. As quickly as they can go on, they can also come off, they can be delayed. If you think about Trump, he's actually put a delay on the auto sector. So, it can be quite fast-moving, so quite easily we could have a bit of a reversal.
And what we know from Trump's first presidency is that tariffs are normally just a negotiation type tool that he uses. So he's normally looking for some sort of deal. We don't really know what that is at the moment, but as you've mentioned there, Joe, if he gets a deal quite quickly, he can take those tariffs off as quick as he put them on.
Exactly.
Okay, so that's the US. What's going on in Europe at the moment, Joe?
Yeah, so Europe's been a bit of a flip side, and just, Matt will come on to the market returns in a minute, but it's why we're multi-asset, it's why we diversify our exposures. Europe's done really well so far this year. We've had some pretty big news out of Europe this week, so it's come out of Germany. Typically, Germany's been known to have pretty tight fiscal budgets. You know, it's
Yep.
been pretty conservative in those. But actually, it's taken the defence spending essentially out of that calculation of the fiscal budget,
Yep.
which means that, you know, it can allocate that spending elsewhere, and it's almost actually making the defence spending, it can virtually be unlimited.
Yeah, if it wants to.
Yeah.
And I think that comes back to, you know, the volatility around Trump himself. This is a consequence of what we saw between the US and Ukraine, Germany looking to do this. So as part of the defence spending, they're actually looking to give aid towards Ukraine as well. So anything else you would highlight, Joe?
Yeah, I guess around the Europe, you know,
Yeah,
that
around
defence
Europe.
that defence spending, you know, it's good for growth. So
Yep.
you'll come on to the equities in a second,
Yep.
but maybe slightly a bit inflationary again. So we'll raise those fears around inflation somewhat.
Yeah, so I think from a market perspective, equity markets have looked at this and thought, good news, we'll get more government spending, that should be GDP positive. So what we've actually really saw from European equities is that, as you've mentioned, they've been the best performing equity market this year. So they're up about 12%. So a total contrast to the story that we're seeing within the US, and almost coming into the year, another total contrast where valuations were much cheaper, investor sentiment was pretty poor. People are thinking growth prospects don't look that great. And as you mentioned, this total sea change that we've seen come through in Germany has actually really powered on European equities. But similar to the US, German bond yields, they've really moved out. So this week alone, they're out 41 basis points. Most of that was on the one day of the announcement of, look, we're changing the fiscal rules. And basically, if we want, we can spend as much as we want on defence, and that'll all be funded from extra borrowing. So, you know, markets reading that, once again, positive for growth, probably positive for inflation. So that's not really necessarily the best conditions for the bond market, but equity markets have moved higher. So I think from us, the summary that we're thinking about is really diversification, as you mentioned, Joe, very important, helps us navigate these pockets of volatility that occur. You know, markets at the minute are reacting to headline news. You know, tariffs are coming on, they're being delayed, they're being paused, and as you can see in the equity markets, it'll sell off, it'll rally, it'll sell off. So really what we think is important is to remain diversified and actually keep focused on the long-term goal. Don't get distracted by the short-term headlines. Think about that long-term goal and stay invested. So thank you for watching this week's video, and we'll catch you on Monday.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.